There's a very specific feeling you get when you look at a stock chart on a red day.
Oh, absolutely. It's usually just frustration.
Right. Frustration, maybe a little anxiety, especially if you're just sitting there watching your own portfolio balance tick down in real time.
Yeah, nobody likes seeing red on the screen.
Nobody. But today, we're actually going to flip that script completely. We are looking at a scenario where a day where the stock actually lost value, might actually be one of the most bullish signals we've seen in weeks.
Which I know sounds completely counterintuitive.
It really does.
Usually we just associate green with good and red with bad. It's human nature.
Hmm.
But the market is rarely ever that binary.
Exactly. It's nuanced, and we're going to unpack that nuance by looking closely at SoFi's recent market performance.
Right, because on the surface, yesterday looks like a loss. But if you actually look at the broader context, the macro data, the institutional flows, the short seller behavior, it starts to look a lot less like a breakdown and a lot more like a fortress just holding the line.
A fortress holding the line. I like that. Because we aren't just reading the ticker tape here today. We have a massive stack of sources to get through for you all.
A lot of data to unpack.
Yeah, we are talking about GDP numbers that shocked the market, inflation data that just won't go away, and some very strange movements in the dark pools.
It was a busy day.
So the mission for this deep dive is pretty simple. We want to figure out if yesterday's volatility was a warning sign to get out, or if it was actually a flex of hidden strength.
And to really do that, we have to talk about the concept of market resilience.
Right.
Because, it's easy for a stock to go up when everything is sunny and the market is rallying.
Mm-hmm.
The real test is how a stock behaves when the macro environment is essentially throwing bricks at it.
And yesterday.
Yesterday, the macro environment was definitely throwing bricks.
Heavy ones, yeah. Let's start with the damage report, just the raw price action. If you just opened your app at the closing bell, you saw SoFi at $19.02, which is down 1.45%. On a normal day, that feels like a standard kind of performance, just a slow bleed.
But if you were actually watching the tape all day, it wasn't a slow bleed at all. It was a battle.
A total battle.
We saw a daily high of $19.19 and a low of $18.51.
Which is a huge range.
Yeah, that's roughly a 3.5% fluctuation within a single trading session.
For a stock trading at this price point, a 3.5% swing is a lot of ground to cover intraday.
It really is. And this is where we have to distinguish between the different types of people listening to this right now.
Okay, let's break that down.
If you're an active trader, someone who's looking for intraday scalps or swing trades, that 3.5% range is basically your playground.
Right, because volatility is opportunity for them.
Exactly. That volatility provides the liquidity and the movement you need to get in and out. Traders love seeing that kind of range.
But most of the people joining us for this deep dive probably fall into the long-term investor category.
I would assume so, yeah.
They aren't trying to scalp 10 cents here and there. They're holding for the long haul. So when they see a 3.5% swing and a red close, does that volatility actually matter to them?
It matters, but not in the way you might think. For the long-term investor, that daily volatility is mostly just noise.
Just static on the radar.
Pretty much. In fact, if you're someone who is dollar cost averaging into your position, dipping down to that 1851 level is actually a gift.
It's an opportunity to lower your cost basis.
Precisely. The key takeaway from the price action yesterday wasn't necessarily the volatility itself, but where the price ultimately landed.
It closed at 1902.
Right. And technically speaking, that is really significant. It's sitting right between key pivot levels.
And it hasn't touched its 10-day moving average in a few sessions.
Exactly. It's essentially floating in this consolidation zone. It didn't crash through support, but it didn't break out either. It held.
Okay, but just saying a stock is holding doesn't sound all that impressive until you look at what it was holding against.
The context is everything.
Because yesterday was not a quiet Tuesday. We had a massive data dump that would usually send high-growth fintech stocks right off a cliff.
This is the context that completely changes the narrative here.
Yeah.
You just cannot evaluate a stock in a vacuum. You have to look at the weather conditions it's flying through.
And it was flying through a hurricane.
It really was. Yesterday, we had two major pieces of economic data drop simultaneously. We had the PCE and the GDP.
Let's tackle the PCE first. For those who don't track this daily, this is the Personal Consumption Expenditures Index. Basically, it's the Federal Reserve's favorite way to measure inflation.
Correct. And the print yesterday came in, quote-unquote, hotter than expected.
Hotter meaning inflation is still stubbornly high.
Right. Now, we've been talking about this sticky inflation narrative for a long time across the broader market, but actually seeing it in black and white definitely rattled investors.
Why does a slightly hot PCE number matter so much for a company like SoFi, though?
It all comes down to interest rates. The entire bullish thesis for fintech stocks right now is built on this expectation that the Fed is going to eventually cut rates.
Because lower rates mean cheaper borrowing costs.
Exactly.
Yeah.
Cheaper borrowing costs lead to more loan originations, more consumer spending, and ultimately better margins for a company like SoFi.
So when PCE comes in hot,
It tells the market, not so fast. It pushes those anticipated rate cuts further out into the future. And historically, that is absolute kryptonite for growth stocks.
okay, so that's strike one. Inflation is still being annoying. But then we got the GDP number, and this was the one that really seemed to just shock everybody.
The GDP shocker. The expectation was for decent, steady growth, but the actual number came in at 1.4%.
1.4%. That sounds barely alive.
It is very sluggish. It borders on stagnant, honestly.
What caused that huge miss?
Well, the sources indicate this was largely driven by inventory issues. Companies essentially aren't stocking up on goods because they're worried about future consumer demand.
And there's also the tariff uncertainty playing into that, right?
Absolutely. But here's the real problem. When you combine hot inflation from the PCE with incredibly low growth from the GDP, you get a very scary economic word.
Stagflation.
Exactly. Stagflation is the absolute worst-case scenario for the markets.
Because it means the economy is slowing down, but prices are still going up anyway.
Right, and the Fed gets completely stuck. They can't cut rates to help stimulate growth because inflation is still too high, but they also can't raise rates to fight the inflation because economic growth is already dangerously low.
It's a catch-22. And in a stagflationary environment, speculative assets and growth stocks are usually the very first things to get aggressively sold off.
People panic. Investors run to safety. They buy utilities, gold, consumer staples, and they usually run as fast as they can away from fintech.
Which is exactly why yesterday's performance for SoFi is so incredibly interesting. You had a classic stagflationary data setup.
The perfect storm.
Right. The algorithm bots that trade on those macroeconomic headlines should have hammered SoFi into the ground. And sure, it went red, but down 1.45% amidst all that terrible data.
It is remarkably contained. It really is.
And we haven't even mentioned the Supreme Court yet, because they threw a massive wrench into the gears yesterday regarding tariffs, and it felt like the market just didn't know whether to laugh or cry.
That whole sequence was a perfect example of market schizophrenia.
Walk us through what happened there.
So the Supreme Court struck down global tariffs. And initially, the market algorithms just read tariffs gone and immediately interpreted that as costs down, profits up.
So we saw a huge spike.
A massive market-wide spike across the board.
But only lasted for, what, maybe 20, 30 minutes?
About that, yeah. Because then the human traders stepped in and realized that while the specific tariffs might be gone for now, the broader regulatory uncertainty is still very much there.
And the market hates uncertainty more than it hates bad news.
Exactly. The market wants predictability. So the initial spike just faded away completely.
Yeah.
But again, look at SoFi during all this.
It rode the roller coaster.
It rode the spike up, it rode the drop down, and it still finished relatively flat compared to the sheer volatility of the broader indices.
Okay, so we've clearly established that the macro environment was hostile. It was a storm, but SoFi didn't capsize. Now I want to look at the other side of the equation.
The internal mechanics.
Yes. We saw some filings, specifically Form 4s, pop up yesterday. And I know whenever retail investors see that executives are selling stock, they tend to get very nervous.
It's a very common reflex. You get the alert on your phone,
Yeah.
insider selling, and you immediately jump to the conclusion, oh no, they know something is wrong, the ship is sinking, they're getting out.
But you have to actually look at the paperwork.
You do. Because these particular Form 4 filings are almost certainly linked to 10b5-1 plans, or what are commonly referred to as Rule 144 notices.
Let's break that down for everyone, because Rule 144 notice sounds like the kind of dense financial jargon that immediately makes people tune out.
Fair enough. Think of a Rule 144 notice as raising your hand in a classroom and asking the teacher for permission to leave in 5 minutes.
Okay.
You haven't left the room yet. You are just telling everyone publicly, hey, I'm going to walk out that door soon.
Yeah.
The Form 4 filing is the actual act of walking out the door.
So by the time we, the public, actually see the Form 4, the decision to sell those shares was made weeks or maybe even months ago.
Exactly. It is entirely pre-planned administrative housekeeping.
Usually for tax purposes, right?
Taxes, portfolio diversification, paying for a house, whatever. The point is, it rarely reflects the executive's current real-time sentiment on the stock price today.
So when you see those filings come through on a chaotic day like yesterday, it's literally just a coincidence of timing.
Completely. It is absolutely not a panic reaction to the bad GDP number.
Good to know. So we can ignore the administrative selling, but we cannot ignore the short interest. This is the part of the deep dive that I found the absolute most fascinating.
Well, the short seller data from yesterday is wild.
We are talking about the people actively betting against the company.
The bears. And right now, there are a lot of them surrounding Sofi. Currently, about 8.8% of Sofi's free float is shorted.
Which translates to what? Roughly 111 million shares?
Yeah, about 111 million shares sold short. These are investors who only make a profit if the stock price collapses.
So I want you to put yourself in the shoes of a short seller yesterday morning.
Okay.
You wake up, you see hot inflation data, you see a massive GDP miss, you see the broader market stumbling. This is basically your Christmas morning, right?
You should be, yeah.
This is the day you press the button and drive the stock into the dirt.
Logical game theory says yes, absolutely. If you are a bear and the macro data perfectly supports your thesis that the economy is crumbling, you should be doubling down.
You should be aggressively borrowing more shares to sell into that weakness.
Right, trying to trigger stop losses and cause a downward cascade.
But that is not what happened.
No, it isn't. In fact, the data shows the exact opposite behavior. On a red day, amidst terrible macro news, short sellers actually returned about 527,000 shares.
They gave the shares back. They closed out those positions.
You covered, yes.
Yeah.
Now, to be fair, returning 500,000 shares out of 111 million isn't a massive short squeeze. It's not going to suddenly skyrocket the stock price.
But the direction of the move is what really matters here.
Exactly. Why would you retreat when the battle is seemingly going your way?
That is a million-dollar question. If I'm sitting at a poker table and I'm winning the hand, I don't suddenly fold. Unless I think the game is about to change.
Or unless you think your downside is extremely limited. This behavior is a massive signal of a lack of conviction from the bear camp.
They didn't trust the drop.
Right. It suggests that the quote-unquote smart money on the short side looked at that $18.50 level, looked at the historical support, and thought, you know what? This thing isn't breaking.
The macro news was awful, and it still held.
Exactly.
Yeah.
We better take our profits now, because if that GDP data didn't kill it, what will?
And if bad news can't kill the stock, what happens when we actually get some good news?
That is exactly what the short sellers are afraid of. If the stock shows this much resilience during a severe macroeconomic storm, the bears know that any sudden ray of sunshine, any positive catalyst, could send it ripping higher.
So they're de-risking.
They are stepping back. To me, seeing short sellers retreat on a red day is actually a far more bullish signal than seeing them retreat on a green day.
Because it shows they're genuinely scared of the floor.
Precisely. They respect that support level.
Now, we have to pivot and talk about the elephant in the room. Or, I guess, maybe the whale in the pool. The dark pools. We saw some absolutely massive volume yesterday.
We did. And for anyone listening who might not be familiar, dark pools are not some sinister, illegal backroom operation.
They sound like it, but they aren't.
Right. They are simply private exchanges utilized by massive institutions. We're talking pension funds, hedge funds, mutual funds.
Why did they use them?
To trade incredibly large blocks of stock without moving the public market price too drastically.
Because if a hedge fund tried to just market sell 22 million shares on the open NASDAQ queue, the price would crash instantly before they could even fill the order.
Exactly. The slippage would be astronomical, so they do it privately off exchange.
And yesterday, right around 12:24 p.m., we saw a massive print hit the tape.
A huge print.
A block of roughly 22.1 million shares, and then another chunk of 8.8 million shares. This is just an immense amount of volume.
And naturally, when retail investors see those numbers flash, the fear immediately kicks in.
Oh no! A whale is dumping their shares. Someone knows something terrible. Abandoned ship.
That is the default psychological reaction. But we have to be very careful with how we interpret dark pool data.
Because it's opaque.
Very opaque. The tape doesn't explicitly tell us if that transaction was a buy or a sell in the same way the public market does, because these trades are happening between the spread. We don't actually know the institutional intent.
So it could easily be a massive buy order.
It absolutely could be a fund massively accumulating shares,
Right.
but there is another very strong possibility that fits the current market narrative even better:
Which is?
sector rotation and portfolio rebalancing.
Meaning they aren't necessarily dumping SoFi because they hate the company. They are just shifting their entire portfolio strategy.
Exactly. If you look at the broader market right now, we are seeing a massive coordinated rotation out of growth and AI stocks
Yeah.
and money moving into value and defensive stocks.
Right. Taking profits on the tech run.
Yes, large funds have strict mandates. They have to keep certain percentages of their capital allocated to specific sectors.
So if their AI stocks went up 100%, they become overweight in tech and they are forced to sell them.
And conversely, if their fintech exposure is suddenly out of balance, they adjust.
So seeing 22 million shares move in a dark pool might literally just be a fund manager balancing a spreadsheet to hit their quarterly targets.
It is very, very likely. What looks like total chaos to the retail day trader is often just basic math to the institutional fund manager.
That makes a lot of sense.
And here's the really key point. If that dark pool print was a pure dump, if a massive whale was aggressively liquidating their entire SoFi position because they believed the stock was doomed, the public price would likely have suffered way more than 1.45%.
The broader market would have sniffed out that kind of institutional panic.
The market always sniffs it out eventually. The fact that the stock price managed to absorb that staggering amount of volume and still stay completely within its pivot levels tells us something very important.
What's that?
It suggests that for every single seller in that dark pool transaction, there was a very willing, very capable buyer on the other side.
It takes two to tango. Someone happily bought those 22 million shares.
And they bought them right in the middle of a horrible GDP miss and a major inflation scare.
You really have to ask yourself, who has the confidence and the capital to buy millions of shares of a volatile fintech stock on a day when the American economy looks like it's stalling out?
It's definitely not a panicked retail trader on their phone, that's for sure.
No way. That is long-term institutional money stepping in.
That is the smart money quietly building a major position while everyone else is completely distracted by the scary macroeconomic headlines.
So let's try to pull all these different threads together for everyone listening. We have a stock price that went down, but successfully held its critical technical levels.
Yes,
We have a macro environment that is essentially screaming stagflation, which should be fundamentally terrible for this specific stock, yet the actual damage was minimal.
very minimal.
We have short sellers actually retreating and covering their positions instead of attacking the weakness. And finally, we have massive institutional dark pool volume churning just under the surface, completely absorbed by the market.
When you synthesize all of that data together, the overall picture is one of healthy consolidation, not a collapse.
It's a very different narrative than just red day bad.
The phrase I keep coming back to when looking at this data is building a base.
Building a base. It almost feels like the stock is hardening, like they're pouring concrete.
That is a great visual. In technical analysis, the longer a stock trades sideways or consolidates within a tight range, the stronger that base or that floor becomes.
Because it shakes out the chorus.
Exactly. It effectively resets the entire investor base. The weak hands, the people who panic, sell at a 1.4% drop. They leave the stock. And the strong hands, the major institutions, the long-term believers, they step in and happily absorb all that supply.
And once all those panic sellers are completely gone from the equation,
The path of least resistance for the stock becomes up. But this base building process takes time.
it's not an overnight thing.
No, it is boring. It is frustrating to watch daily. It requires a level of patience that most active, short-term traders simply don't have.
Which really goes right back to the difference between the trader and the investor we talked about at the top of this deep dive.
Perfect circle.
The trader looks at yesterday and just sees a volatile 3.5% range to exploit for a quick buck. The investor looks at yesterday and sees a severe stress test that the company completely passed.
Correct. If you fundamentally believe in the long-term thesis that nimble fintech companies are permanently taking market share away from slow, legacy banking, then days like yesterday are actually deeply reassuring.
Reassuring because it shows durability.
They prove that the stock isn't just made of glass. It can take a direct punch from the Fed, it can take a punch from the GDP report, and it can stay standing.
So for you listening right now, trying to figure out what to do with all this complex information, don't let the red color on your screen fool you.
You really have to look under the hood. Sometimes the sheer absence of a total collapse is the most powerful signal of a future rally.
The silence is deafening.
The shorts are actively signaling caution, not aggression. The institutions are churning high volume, very likely accumulating shares. The macro environment is bad, yes, but it appears to be entirely priced in.
It's the calm before the storm, but maybe the good kind of storm. The kind of storm that lifts boats instead of sinking them.
Now, I wouldn't go so far as to predict a massive rocket ship tomorrow.
Sure, we have to be realistic.
We are still navigating a macro minefield. But the floor under this stock looks incredibly solid. And in this current market environment, a solid floor is really the best thing you can ask for.
I think that is the perfect place to wrap up the analysis. We unpacked the macro nightmare, the short seller retreat, and the dark pool mystery.
And hopefully we help turn a seemingly scary red day into a highly positive data point for market resilience.
I want to leave you with one final thought to chew on as you go about your day. We talked a lot about the bears retreating. If the people whose entire financial livelihood depends on this stock failing are starting to pack up their bags on a day when the news is objectively bad.
It really makes you wonder.
It does. Do they know something about the floor of this stock that you don't? And if that floor really is as solid as the data suggests, what happens when the ceiling finally cracks? Are we just looking at a breakdown or the quiet building of a launch pad?
Something to carefully consider.
Definitely something to think about. Thanks for being with us on the deep dive. We will see you next time.
Stay curious.